In this video, guys, we're going to look at if you're losing too many trades, try this. Stay tuned. Hey traders, warm welcome to you. Alright, so if you are losing too many trades, it means simply that you are getting stopped out after time after time after time. And that we can address, because listen, we all want to have a really tight stop. The dream trade is we have a huge position size, minuscule stop, and the trade just goes on and on and on, and we're making substantial amounts of money for every tick that thing moves. That's the dream. In reality, it very rarely works out like that, guys. We know the case, and so we kind of try to do this. We try to move the stop tight, and yes, there are some setups and strategies where a tight stop is the correct thing to do. It's the right thing to do for the trade, and it's nice that it's like that as well. We can quantify the risk. It's a good place to put it, but most of the time we've got to give stuff a little bit of room to breathe. We've got to kind of, even if it's below the support, even if it's this, if it's that, even the wick length might be a decent thing, and we've got to be under the wick. So we have to give things room to breathe, but as traders, we don't want to. We think the less risk we've got means the tighter stop, and then we just lose our time after time after time. So the number of trade losses becomes significant. So the couple of things we can do to try this. The obvious one, guys, is what we do is we widen the stop. Now that might seem very, very simple, and it is, but using a specific strategy and a specific formula. What we do is we trade on the time frame chart we're trading, or we look at the time frame chart we're trading, should I say. So if we're trading a daily chart, we're looking at daily candles. If we're trading a 5-minute chart, 5-minute candles. Wouldn't necessarily go down to a 1 minute. If we're trading a 1, I'd stick to a 5, but that kind of order of magnitude. If you're trading a monthly chart, a weekly, then use your weekly candles. What you need to do then is you need to, in the current trading period, now I'm giving you a bit of flexibility with this, that may well be the last 10 days, it may well be the last 2 days, it may well be the last 2 quarters, when you've got similar type of trading. So for example, let's say you've come off a high recently and you've had 5 days moving lower, it's going to be those 5-day period. If you've been in a range for the past year, it's going to be that year. If you suddenly accelerated over the last 3 days, it's going to be the last 3 days. This is up to you to determine when the conditions have changed and are we still in the current conditions. So once you've done that, you look at the conditions. Okay, so this is a little bit of flexibility here, but you know what I mean when I talk about that. When you see that the conditions have changed, maybe after earnings, maybe something come off a high, may have been trending for 6 months, whatever, you know there's been pretty similar conditions. So that's the segment you take. Now you find the largest candle in that area. So you say, okay, these are the conditions for the last 5 days. I'm on a 15-minute chart. What's the largest candle for 15 minutes? The largest candle for 15 minutes has been 75 ticks. There's your stop. That is your stop. Now, most of you are going to go, that's ridiculous. It's way too wide. It's horrible. And that's the chimp, if you like, inside you who wants to have that tight stop, saying no, can't do 75, can't do 75, my target's only this, and even if I'm trading minimum size, I'm going to get hammered by it. Just think for a second how many of your small stops you've done and you've hit that. So even if you've got a 20-point stop, you get stopped once, you get stopped twice, you get stopped 3 times, you get stopped 4 times, more than you would have done if you'd taken that one trade, and likely you wouldn't trade as much and you wouldn't feel the same pain, and more probably you've got the odds on your side much better. So if it's a daily chart, for example, that might well be X%. So you adjust it if you're swing trading or day trading. The point is you use the conditions, you find the largest candle, and I'm talking about the range here, guys. So from top to bottom, bar, candle, whatever, and then you're using that. Because what we're trying to do here is we're trying to go from one extreme to the other. Many losing trades most of the time is going to be down to having the stop too tight. Because if you had a wide stop, you'd probably still be in a trade, or you close it maybe manually a little bit later and you wouldn't be getting stopped out constantly. A wider stop allows you to sit through that noise. So of course, you're gonna have to reduce your position size depending on what the stop is. If the stop order of magnitude is changed by 3, you have to divide it by 3 position size if possible. possible. If not, you have to stick with the minimum, but you're going to have to reduce the number of trades that you allow yourself to take in the week or in the month or whatever. So adjust the risk somewhere. Don't just take with one hand and not give with the other. You've got to make the adjustments both sides. So what this will do is it will keep you in more trades. Just statistically speaking, probability of touch is twice that the probability of it closing in an area. So comes to an area, touches it, chance of it staying there is 50-50. And so, and this is if we're doing pure maths on this, it's 50-50. So the stop kind of crystallizes a loss. I'm nothing against stops, they've got to be there for a reason, but the point is having it wide enough, and this is trying to attack this problem we have. If we go in the probability of touch is twice that, it touches it, markets pull back. You know yourself, this is why you're getting stopped out constantly. A lot of the times the market's hitting it or running through it and coming back. If the stop wasn't there, and again, I'm not advocating not using a stop, there's a time and a place for potentially doing that. I've done a video on that before, and I'm going to do another one in the future, so stick around for that. But it's there to limit the loss you have. However, if you widen it, or you take less trades, or you reduce your position size, or you do something to mitigate the extra risk taken by that, you'll find yourself in the trade for longer. And the beauty of finding yourself, listen, is it going to cure you and make you a profitable trader? No, it's not. However, what it will do is it will keep you in trade. You won't get the death by 1,000 cuts. Your win rate will increase because your stop is wider. Now you're gonna have to do something potentially with your limits, but even if you don't, all right, even if you don't, and even if you go for a risk reward ratio that's skewed the wrong way, you know, for example, and I know people are going to, well, you can't do that, you can't do that. This is an exercise in improvement. It's not an exercise in the perfect trading strategy. It's trying to deal with this. So even if you do keep your initial targets at whatever they were, 25 ticks if you're day trading, you know, 2% and you're risking 5%. Even if it's skewed, what it's doing is it's going to give you good information about the type of trades that are working for you. It's going to help you become calmer because you're going to be in a trade longer. You're going to reduce the frustration, and it's less frustrating, ironically, to lose once on one trade than it is to lose 10 trades in a row and lose 7.5 ticks or whatever, if it's 100 ticks, 10 ticks each time. It's much less damaging psychologically. So even though the financial situation may well be the same, the point is you're calmer, you can see a bit more clearly, you can analyze things, you can adjust things, you can tweak, you can change your setups, you get some information to work off in the future as well, so it works for you. So even if you do use those same limits, you're still in a similar position that you were, and it just gives you a bit of breathing space to go, right, I'm getting constantly stopped out, I'm losing so many trades, right, why don't I just take the risk that I would risk in a week or risk in a few days, widen the stop to that, and that's a method you can use, like conditions, then look at the largest candle, or just say my biggest risk, what am I prepared to risk in a week, what am I prepared to risk, X hundred, X thousand, right, that's my stop. Take one trade, let's just see what happens with the trade, and go from one extreme to the other. Your financial risk hasn't changed. Nothing's changed from that perspective, but what you've done is you've given yourself time to think, and you've stopped that death by 1,000 cuts. You've stopped that urgency, you've stopped that panic, you've stopped that frustration, the anger you get when you're getting stopped, you're getting stopped, you're getting stopped. Then you can start to bring things in. Then you can start to tighten things up a little bit and find that sweet spot. All right, guys, if you are getting stopped out multiple times, you're losing too many trades, try that out. Widen out that stop right out. Adjust the risk accordingly, depending on number of trades and position size. And let me know how you get on in the comment section below. Take care, whatever you're doing, bye-bye.